Hello, hello, hello. Welcome to Our Stock Trades. In this video, we're going to go ahead and analyze the company Adobe. Now, I find this company incredible, and I'm going to explain to you why. And we're going to go ahead and calculate the value of said company to see at what price would be fair value. So we're going to go ahead and switch our screens over here, and we're going to go one by one. And I'm going to remove myself from the camera so you can see this section here because it's all important. So as you can see here, the top line here in revenue, Adobe in this kind of a mini dead half decade, the revenues didn't really do so much for Adobe. In fact, it was only until 2017, 2016 and on that Adobe started firing on all cylinders. So in this calculation, what I'm going to do is I'm going to take the net income from 2012 to 2022 or TTM to what we have right now, and then I'll do 2016 to 2022 based off of its free cash flow. So we're going to do two intrinsic value calculations to find the fair value. But what I'm looking at here is I'm looking at the gross margins of Adobe, and looking at it, it's like literally 88% to 87%, on average above 85% gross margins, which means that every dollar that Adobe makes, they get to keep 85% of it. I mean, it doesn't get any better than this. But I do have to say something with their Figma acquisition. They paid top dollar for it, especially during an inflationary, recessionary time. So that's a big no-no Wall Street had in mind. But I assume, again, this is one of the greatest companies in the world. I believe there is a market share that Figma can give them, but they did buy more than the present value of the company, which means that we may not see the fruit of this labor until 2025 and 2026. I wanted to toss that out there for people that are looking closely into the company here. But what I see here is the operating margins are continuously getting better. The earnings per share is more for the people that own the stock. And in terms of dilution, there isn't really any. It's been hovering under 500 for quite some time. In terms of book value, obviously this company provides tremendous value to the investor, and the free cash flow speaks for themselves, going from 1.2 billion to 7.1 billion. Again, these numbers are in millions. So we're going to go ahead and we are going to be calculating the intrinsic value, and I'm going to take you towards this intrinsic value calculation, and all the numbers that you saw on this screen, we're going to put it in this one and in this two tab here, intrinsic value. And let's first look at let's not look at the stock price, okay? Because that's not what fundamental investing is all about. We want to go ahead and calculate the value first. So what I'm going to first do is I'm going to do the 10-year analysis. And if you were to graph this for people that are they know math really well, if you calculate the slope, or if you were to graph this, at what level do you think the slope starts increasing? Obviously, the slope here doesn't seem as steep. Then all of a sudden, from here to here, it starts growing at a rapid rate. So we're going to go ahead and do two calculations. One that takes the intrinsic value of the 10-year, and this one takes the intrinsic value of 1, 2, 3, 4, 5, 6 years. Okay, so let's go ahead and without further ado, let's get started. You can fast forward through this or watch me in the process. So we're going to go ahead, and I'm just going to stop talking and just get to it. 129 682 5308. And as you can see, I'm just putting it right here. 35 1996 2 988 and then 1229. And again, you can find this below in their Mastering Stock Market course link down below. But you can see here, we took these numbers and we literally took it from here. And again, the numbers, the years doesn't have the match up. It just takes the average. So now we're going to take the net income from the TTM, the trailing 12 months, which is net income here. So we're going to take this net income and we're going to go ahead and find the growth rate of the company. So without further ado, let's go ahead and do it. 2012. 833, 2021. Oh, nope, 2022. We got net income here, 481. And this is going to continue growing. So, but we just want to, it's going to probably grow more, but we'll see. We're going to go ahead and extend this out to 10 years. So you're going to see the years go to 2032. See how it goes there. You can also do 5 and you see how it goes to 2027, but we're going to do 10. And we're going to divide by the number of outstanding shares, which is 469 million. And when you do this, you find an intrinsic value of the company of a recession level of $93, a bear case of 176, a base case of 235, and a bull case of 334. And this is kind of the longitudinal. But again, I do not believe this is the accurate value of the company. I do think it is much higher, given the fact that 2012 to 2015, for many people in our Mastering Stock Market course, you've realized that these years tend to be very like a dead decade. But you may want to include that since we may be entering one ourselves, half of one before the Federal Reserve pivoted in 2014 to 2015. So let's go ahead and take a look at the stock price now to see what is Adobe currently trading at. So Adobe's currently trading at $275, which is right between our base and our bull. Now, again, this could be worse because if you go ahead and look at the revenue estimates, 2023, and again, these are analysts. These are by analysts. And again, you don't want to trust analysts, but I think it'll be great to essentially see what analysts think this price target for this company could be at. And we look at here, and they're thinking 12.8%. So you can drop this in here, 12.8%, and you can see this may be the value of the company, which means that if you buy the company at $210, you should expect a 10% return year over year on your investment. But I doubt that they're going to be growing at 13% on terms of their net income. Who knows? They might. I mean, they are technically growing 12.6%. So they are right on line of what analysts are thinking. And you have to understand that we're approaching an era where big tech is finally getting hits. Google, your Facebook, right? And this is going to be a very hard time for big companies to essentially grow. The era of Silicon Valley growth is limited, and the next phase of the fourth industrial revolution is going to take off. And this is great for small cap companies that are invested and entering the tech world. Okay, so but with this here, we're going to go ahead and look at this calculation, but this time we're going to remove these years here. We're going to remove these years. I don't think revenue is going to be growing this stagnant for some time. I think we're going to continue growing our revenue for this company. So I'm going to remove for the free cash flow here. I'm going to remove these free cash flows. 1229 all the way up to 1342. So 1342. So all this here will be removed. And we're going to keep 2016. In fact, we just need 5 years. So 1, 2, 3, 4, 5. So I'm going to go ahead and remove this too. And once we remove this, then we get a stock price anywhere between $92 to $295. But remember, when we originally calculated this, and we can go ahead and redo it again here, we can recalculate the growth rate here. In 2016, they had, let's see here, we could just look at it here, 2016, they had 1169. In 2022, again, it is going to be a higher number here, where they had 4813. And by doing that, we're growing at 27%. We're going to increase it by 10. Then we're going to go ahead and, so 27%. So let's put 27% here. And on average, the stock price can go anywhere between $205 to $823. Now, again, I doubt that this company is going to grow 27%. The original calculation was 19%. So if you replace this 2012 to 833, so let's do that. 833 to 2012, they're growing at 19%. So if they did purchase Figma, so that is growing on multiple cylinders, but you can see the stock price now for this is hovering anywhere between 245 to 465. So I would say, without an unassailable amount of doubt, I would say 245 to 326. The stock price is currently trading at 275. I would say based off of this is I would call it a 13% discount rate. No, I would say 14% discount rate. Yeah, about 14% discount rate is what it's trading at right now. I would say based off of the current share price, we could expect around a 14% year-over-year return for the next 3 to 4 years for Adobe from this current share price. And if we put the share price of $275 here, we can either hold the company and essentially get its 14% year over year, or if it does go above its intrinsic value, meaning if it does cross over, then it will be definitely a great sell. But this is a really good price, I would say, because you would get anywhere between a 20 to 69% return, and you're looking at a company's free cash flow that is extremely generating. It adds value. There's no dividends, but there is added value to earnings per share, which means that is reflective to the stock price, and your book value is incredible for this company. So I would say this is with high gross margins, this is a great company to get into, and it's great. In fact, I'm curious here. Sometimes analysts have their own price for a company, but I would say based off of this, you can do the halfway point between 326 to 465. But honestly, I would say 350 is a great price to get out of this stock. 350 is a good price, and honestly, it falls in line to around what analysts are saying here. But sometimes analysts get it wrong. It's just Adobe is such a very well respected, looked at stock that analysts tend to follow the rules on that one when it comes to intrinsic value calculations. But you can see here how we were able to essentially calculate the price target of the company just based off of the books, right? So if you look at the stock price, you can see when it was overvalued here, trading at 650. I mean, whoever bought it here honestly doesn't know anything about intrinsic value. Now it's finally going to its historic mean, even actually way below its historic mean. I mean, we're technically down 50% year over year, but in the 5-year mark, we're still up 82%. So I say this is definitely a company that is something that is of interest. I do believe that if it goes down lower, then it will be even a better company to get into. If I was to use our intrinsic value calculation that's automated from our Discord here using our proprietary brain machine model, part of our Al Stock Alerts platform, I think it would be reflective of the same, but we don't know until we try. So let's go ahead. In fact, let's do a different room here. Let's open up our help menu. And let's go ahead and do intrinsic value calculation. Click that button over, and let's do the leverage DCF, and let's do Adobe. And what this does is it goes out to the future, 2024, then 2025. But anyway, it gives you the price target. And it looks like the price target here is $472, which is right in line with the bull case. So you really honestly can't go wrong with this stock. Again, 19% year over year. Let's see what it calculates here. So it's calculating a 21%. So again, right in line to what we've been looking at here in terms of the intrinsic value calculation. And if you want to do just a advanced DCF without leverage, let's see what that falls into. Yeah, around 365. So again, 365 to the stock price of $472. And again, this is part of our intrinsic. It does it automatically. And if the company's free cash flow positive, then the calculation's a lot more easier. If it's free cash flow negative, then you would have to do some manipulation, which you know from my Clover Health videos. But overall, I would say for me, I'm getting into this stock here, and I would sell around $350. So my price target for this company is $350 for the next 2 to 5 years, which is around a 20% return, which I would say is incredible, given the fact that it is Adobe and it will continue to grow, and it will always trade above its, in the next coming years, and let's say 2024, 2025, it'll be trading higher than what I would say this is at $326. definitely higher, because of the environment that we're in this whole inflationary time with Russia and Ukraine and China and Taiwan and the whole oil and inflation and the midterm elections, along with a couple of other things happening, which is the interest rates are keep spiking, with the federal funds rate estimated to be around 4.6%. I believe that personally the market is going to be tumultuous for some time. But again, here at Al Stock Trades, we tend to follow smart money and try to avoid what retail investors are doing with their money. But according to dumb money, again, we get this data when you purchase, when you go into, let's say, Robinhood, Webull, Thinkorswim, TD Ameritrade, you give them your social security. And then if you don't have over $100 million or some, what are those numbers, you're considered dumb money. And you can see that every time stocks go down, dumb money sells. And when stocks go up, dumb money buys. And you want to fall in line with what smart money is doing. Again, following in line with Chamath Palihapitiya is talking about in regards to doing an intrinsic value calculation and just honestly doing opposite of retail investors. And again, if you want to learn about how to calculate intrinsic value of stocks so you don't overpay, so you're not that person buying in the upper region of where the company lies, you can definitely consider our Mastering Stock Market course or Al Stock Alerts. Both include the bi-monthly meetings that we are initiating, again, to foster community. As always, it is a privilege and honor to serve each and every one of you, and I will see you on the next one.